In this session, I'm going to cover topics in Chapter 3. I think the title of that chapter is Adjusting Entries, and I've prepared a group of slides that I hope will help make this more clear for you. In the very introduction, I started talking about the steps in accounting, and we've gone through a number of those. First, you have to analyze a transaction and create a journal entry based on your understanding of the cash flow and how that entry should be processed. Next, we went to the transfer of general journal entries into the ledger accounts. And what I don't have here, excuse me, no, I do have total general ledger accounts by netting debits and credits. I think you've learned how to do that. And then preparing a trial balance to see if those debits and credits are equal. In this particular lecture, I'm going to talk about preparing adjusting entries to match revenues and expenses in the correct time period. And then I'll also cover preparation of financial statements, which I went over very quickly in the intro at the beginning of the semester. You'll have to pardon me for my sinuses. Adjusting entries are part of what we call the accrual accounting system. You can have a cash accounting system where nothing goes on the books until it is recognized in cash. For example, you wouldn't put customer billings on the computer until the customer gave you the cash. You wouldn't put the revenue in the system. Likewise, even if you owed somebody a bill, you wouldn't put it on as a liability. You would wait until you actually paid it. That's cash accounting, and it's not nearly as representative of what's going on in a company as is accrual accounting. And I probably have said this before, but under accrual accounting rules, you put revenue on the books when it's earned. It doesn't matter whether the customer has paid you or not. You've earned that revenue. You have a legal right to be paid for it. You put it on the books. Likewise, with an expense, when you incur an expense, even if you're not paying it at that point, you need to put that on the books as a liability because you legally owe that money. And of course, what we're trying to accomplish here is to match up the revenues in a period, in a month or quarter, whatever we're doing, whenever we're reporting financial statements, trying to match up the revenues with the expenses that had to be incurred to earn those revenues. Okay. In point 3, a problem in matching revenues and expenses is that in some of the transactions, we purchase assets that are going to last over multiple statement periods of time. Or we may pay an expense that covers multiple periods of time. We may buy something that's going to last for a good long time. We might have a revenue that's not billed in the correct period, or an expense that's not paid in the correct time period. One of the things to remember, one of the things that will hopefully help you keep your entries straight, and it's a big point to remember, every adjusting entry contains either a revenue account or an expense account. The whole goal is to get revenues on the books and expenses on the books when they should be put on the books. So if you do an entry and it doesn't have a revenue or expense account, you have not accomplished what you're trying to do with an adjusting entry. One of the first ones I cover is depreciation expense because it's a totally new concept, one that you haven't had to deal with before. So I'm going to go through 2 examples. Assume your company purchased a truck for $24,000 a year. Number 1, the IRS will not let the company expense that truck when they buy it. They cannot expense $24,000. The IRS basically dictates how long they have to expense that truck. And secondly, you wouldn't want to, because you wouldn't want to put an expense on the books of something that's going to last for 4 years. You don't want to expense all of that in 1 month or 1 quarter because it's going to totally distort your financial results. So here's how it works. In this case, let's assume that the IRS says that they can expense 25% of the original cost each year. The expense account is called depreciation expense. but we don't credit the truck. We put it in an account called accumulated depreciation, which is a contra account. It's a contra to the truck account. That is, we show the truck and we show the depreciation that we've taken against that truck, and we keep accumulating that. And I'm going to show you why we do it that way. So the entry in this case would be a debit to depreciation expense for $6,000, an accumulated depreciation of $6,000. The question you should ask yourself is, why don't you just credit the truck? Now I've tried to illustrate this to the right. This is going to show you what's on the balance sheet. Now assume that you're an investor. You might want to invest in this company, or you're a bank and they're asking you to loan money, and you're looking at the balance sheet. And if you were to credit the truck each year, let's say it's year 3, you give the credit, you give the balance sheet to the bank. They see on there that you have a truck worth $6,000. That doesn't tell them much about the truck. They don't know when you bought it, what you paid for it, how long you've been using it. On the other hand, if you use the accumulated depreciation account, year 3, the bank can see that you paid $24,000 for the truck, that so far it looks like you've used it 3 years because you've used up 3/4 of that amount, and now they can see the book value of $6,000. Same as over here, but in this column they have a lot less information to work with. They don't, over here they would have to call you and ask questions about the truck. Here they pretty much have the answers given to them. The next example is Dominion Virginia Power. Excuse me. Now, Dominion Virginia Power has millions of stockholders. And it would be really hard for them to handle the phone calls if everyone who was going to buy their stock had to call them and ask questions about their power plants. It would be virtually impossible to do. So let's look if we were using the year 1 assumption from the previous slide, and they were crediting power plants. Year 1 power plants would show 29 million. Year 15 they'd show 25 million. I think that is supposed to be year 5 there. Sorry, that's year 5. No, year 5. Year 1 is 29. This thing has slipped out of sync. Year 1 is 29. Year 5 you would see 25. Year 15 you would see 15. Doesn't tell you much about the power plants. Over here, if you picked up their financial statements at the end of year 1, you would see a power plant that cost 30 million. They've depreciated at 1 million, so that probably means, and there's book value left, so that tells you they've used that power plant for 1 year. In year 5, they would have depreciated 5 million, shows you now that that power plant is 5 years old. After 15 years, you can see that the power plant is 15 years old. It's half used up. As you go through time, you can see that the age of these power plants. And as an investor, what you would think was, if their power plants are down to, or they've been used for 29 years out of 30, most likely they're going to have to buy a new power plant. They're going to build a new power plant. Either of those cost a lot of money, which might mean they're going to have to borrow money, which is going to cost them interest and all of that, in order to build a new power plant. Well, that might have a bad effect on their income, which might have a bad effect on their stock price. So do you want to invest in a power company that has a lot of old power plants? Or do you maybe want to look at another power company who has newer power plants and isn't going to be incurring a lot of debt? This is the reason this is done this way. It's for financial statement users' information. What you have to remember for this class is you simply debit depreciation expense, credit accumulated depreciation. If it doesn't make sense to you, that's fine. You can get the answer on the problems or on the test by just doing exactly what they tell you to do in the book. I like to hope that the logic will help you somewhat now or later, but that's totally up to you. All right, the next thing you may have noticed in the book that in our textbook they call office supplies an asset account. You might think of office supplies as an expense, which it is technically. The reason they do it this way is they don't want to have to do an entry every time someone uses a pencil or a pack of paper or something relatively minor like that. An easier way for them to do it is during the period of time, let's say it's a year, they just put all of their office supplies purchased in an asset account called office supplies. In the example here, you can see that, let's say during the year, they bought $3,500 worth of office supplies. They go out at the end of the year, count the value of the office supplies that they still have left on hand, in this case $400. So you have to determine how many supplies were used. Well, if they only have 400 left, they must have used 3,100. So the adjusting entry would be to put what has been used into supplies expensed. Those have been expended. They've been used up. Put those in the expense account. That will give them on the income statement, and credit the supplies account for $3,100. That's going to go over here on this side, and your new balance over here would be $400. So that's how you handle adjusting entries for the supplies account. Companies quite often buy things ahead. For example, prepaid insurance. You buy a 2-year insurance policy. You don't want to expense that whole premium in 1 month or 1 year because it relates to 2 years. So you put that in an asset account and you adjust it as you use it up. So let's say it's now March 31st of the first year. 3 months have gone by. They're preparing financial statements. Now, so we need to correct this account and take out of the asset what's been used up and put the expense on the books. So in this case, you paid $12,000 for 24 months. That's $500 per month is what that works out to be. So for the quarter, it would be 500 times 3, because a quarter is 3 months, of course. Your entry then is interest expense, $1,500. Prepaid insurance, $1,500. So this balance up here is going to go down to $10,005. That's what you have left for the next 21 months. Okay, so you're getting the expense of March onto the books. You're not putting that whole $12,000 into expense because it would not meet the matching of expenses and revenues like we're trying to do under accrual accounting. Unearned revenue, I think I mentioned this in one of my lectures, but not much, I'm sure. When a company receives cash in advance for work it's performed, the entry is you put the cash in the account. And remember, at this point, you've done nothing for the customer. They've given you the cash, so you put that in an account called unearned revenue. That's a liability account. An example that I think you can relate to, if you decide to go to a concert, you buy the tickets up front, you pay with cash, or however you pay, credit card, whatever, it's all cash. The promoter of that concert has your money. If the concert doesn't happen for some reason, the promoter has to give you back your money. So that's a liability until he actually puts on the performance. It's not earned income. Now, once that performance takes place, he has earned that revenue. So you want to get the liability off the books by debiting that. It's a credit, so you're going to debit it to get rid of it and put the revenue on the books. Now, this entry I mentioned in particular because there's not anything in particular to trigger you to think about this, except at the end of the quarter or whenever you're working. If you see an unearned revenue account sitting on the books, the question you need to ask is, have we earned some or all of this revenue? Because you may have. You may just not have focused on that, and you want to focus on that. Next are accrued expenses. The best example of this is salary expense. At the state of Virginia, for example, we get paid on the 1st of the month. So that means for the 1st of September, I got paid for the last half of August. Well, I did the work in August, and that's where the expense needs to show up. So at the end of August, August 31, they should have put an entry on the books to get that salary expense for that half a month on the books and set it up as a payable because they're going to pay it in the future. That gets the expense into the income statement, gets the liability on the books. Somebody looking at the books would know that they owe this money. And then in April, when you actually pay the payroll, you then pay it with cash, and you would take this payable off the books. You would debit salaries payable, credit cash. That gets the expense into the right time period, and it gets the payable on the books. Think about, again, a company like Dominion Resources. If they pay this way, one pay period is millions and millions and millions of dollars. If they don't get that onto the right time period, first of all, it doesn't go in the income statement, and then potential investors don't see that huge liability for all of those salaries that are going to have to be paid in April. So that's the best example. That's the most significant example of an accrued expense that I can give you. And then the next is accrued revenue, totally different from unearned revenue. This is when someone has done work in a company, again, let's say the end of March, they did some work for a customer, they didn't put it into the billing system. They come in on April 5th while they're working on financial statements and say, oops, I forgot to put that on the books. Well, they're going to put in an adjusting entry to put that back into the March. They're not going to go back into March because that's, they didn't do it in time. They're going to do it as an adjusting entry so somebody can see that, whoops, we forgot to put it in March. Here's where we're correcting for it. Okay, so that's an accrued revenue. All of these things are covered in the chapter. However, I hope that, this will clear up some of that for you. Now let me go back, and I want to go back to the very first slide again. Adjusting entries are the next step after the trial balance. And we're doing all of these things, 1 through 6, so that we can get to step 7. In the book, they do not cover preparing financial statements very well, even though that's the goal of all the work that you've done. And so my next lecture will be on preparing financial statements. It'll go back to the very first intro that I did and talk about preparing financial statements, but going through it a little more in detail because that was a lot of information for you to assimilate back then. Now you've gotten into the process, I think it will make more sense to you. So I will do that in a separate video, let you digest this first, and the next step would be for you to listen to creating financial statements.